Welcome. I'm Liz Priestman, the host of IDG's From the Top interviews with our Executive Edge series. Trey Reik joins us again to explore the implications of the Trump 2.0 scenario on the gold market. In this segment, Trey offers us deep insights into how renewed fiscal policies, geopolitical tensions, and shifting global alliances could shape the demand for gold as a safe haven asset. With decades of expertise in precious metals, Trey's analysis provides a compelling look at the factors driving gold's resilience and its potential in the evolving landscape. Trey, it's great to see you and welcome back. Trey, how have financial markets reacted to Trump's reelection, and what are the implications for gold prices?
Great question. So I still remember thinking back to election night in 2016. At the time, heading into the evening, Hillary Clinton's reelection odds were over 90%, and no one thought President Trump had a chance to win. But by 9 p.m., it was becoming clear he would win, and gold was up $65 in the after-hour session, and S&P futures were down 5%, and the world was going to end. But by the next day, the first trading day, gold was flat and the S&P was up 1.1%. And as people factored in the pro-growth Trump policy, economic policy platform, between then and the end of the year, the S&P rose 5%, the dollar index rose 5%, gold was down 10%, and gold stocks, as measured by the Van Eck Gold Miners ETF, or the popular GDX monitor, was down 12.5%. So fast forwarding to the present, since election day, gold S&P is up about 5%, and the dollar's up about 3%. Gold was hit hard on the Trump reelection because everyone was factoring in the trajectory of what assets did back in 2017. So gold in the first week after this victory fell 7%, and gold stocks were down 12%. But already that has reversed a bit, and now gold is trading down only 2%, and the stocks are down about 4.5%. So why is that? And I think the answer is that people have recognized that the difference between 2024 and 2016 is the possibility of a Trump victory has largely been priced in. So really, if you look back in September and October, you started to see the strong, smartest and most articulate investors like Druckenmiller and Dan Loeb announce that they were repositioning their portfolios, and the internals of the markets, industries that would benefit from deregulation, et cetera, started to really outperform in Trump's favor. And stocks in general outperformed their underlying earnings estimates and PMIs and that type of thing. So it was pretty clear, the national polls stayed tied almost to the end. But if you look at betting odds and market internals, et cetera, the markets were adjusting to a Trump victory really for the 2 months, I think, prior to the election. Therefore, a lot of what the surprise factor in 2016 is not going to transpire this time because it's already occurred.
What economic policies do you expect to dominate Trump's agenda? And then how might these policies influence inflation and gold prices?
So the consensus view has been that Trump's big three policy platform, which is tax cuts, tariffs, and deregulation, is going to be very positive for equities moving forward, as it was in 2017. And the difference, of course, there's just this one slight little difference, which is starting points. The S&P has tripled since election night 2016. So we're starting from a much more elevated price for equities. We're trading at 28, 29 times earnings and 3.1 times sales. So while Trump policies may propel stocks higher, it's going to be difficult to have the same sort of performance as they did in 2017. In terms of the big three policies, tariffs, tax cuts, and deregulation, we're of the view that, the big fear of that collection of policies is inflation. So the theory goes that, tariffs are by definition inflationary, and tax cuts will, increase the deficit and lead to more inflation, et cetera, et cetera. But people are forgetting the fact that in Trump's first term, which was very tariff and sanction heavy, inflation averaged 2.1%. So if there's one thing he's a pretty smart operator, and he's well aware of the dangers of CPI type inflation. So our view is that he will not impose the draconian 65% tariffs on all Chinese goods and 10% tariffs on everything else that he mentioned at various parts of his campaign. And it'll be much more using tariffs as that effective negotiating cudgel that he did wield effectively in his first term. In terms of tax cuts, one of the problems is the deficit, isn't going away, and we think it'll be difficult for him to implement all of the different types of tax cuts that he promised at various points in his campaign. He at various times said he would eliminate taxation on tips, on overtime, on Social Security, on the SALT tax, lower corporate rates. So it's going to be hard to do all of that, and therefore we aren't looking for the type of inflation that some fear from the Trump platform. How does this impact gold? Well, we're still in that period of time in the modern era of unconventional central banking, where one of the benefits to gold ownership is expectations of Fed easing in the future. So these fears of inflation caused by the Trump economic policy platform are connected to fears that the Fed will not be able to ease as much as people expect, and that might pressure gold. We think the Fed is much more concerned with liquidity issues and debt issues and the negative net national savings rate. And once you start QE, of course, you can never stop. So we actually don't think CPI inflation, is that connected to gold. They don't have that much to do with each other. If the price of hedonically adjusted hot dogs in Houston goes up, it doesn't necessarily make people want to run out and buy gold. And if the prices of everything in an economy go up, really gold shouldn't go up that much faster than everything else, like thumbtacks. So monetary inflation is a very different animal, and that's where gold comes into play. And we think that the Fed is certainly going to be focused on easing probably a lot more than people expect in the next year or two, which will work to gold's reflexive benefit.
Thanks for that, Trey. Though I have to say, I never thought hot dogs would make their way into a discussion about precious metals. Speaking of things heating up, let's turn to the US deficit. What impacts do you see a second Trump presidency having on the deficit? And how might these developments ripple through the precious metals market?
Mm-hmm. So as much as President Trump is being handed a fairly difficult hand by President Biden, when Trump was elected in 2016, the national debt stood just under 20 trillion at like 19.8 trillion. And today it's 36. So it's up about 83%. And in 2016, the federal deficit was 580 billion. And in the fiscal year just ended in September, it was 1.8 trillion. So President Trump is being handed a whole different ball of wax in terms of where the deficit stands. And there are some encouraging signs. The whole DOGE, Department of Government Efficiency, to be headed by Elon Musk and Vivek Ramaswamy, is certainly enticing to think about and imagine what these two very smart people and the team they assemble may accomplish. On the other hand, government is notoriously difficult to change, and all of these budget changes, departmental changes, will have to be approved by Congress. And the probabilities of making significant headway are much lower than I think most people hope for. So we might get some budget reduction from those efforts. The other thing is, Trump's platform taken in toto is less inflationary than people just focusing on, say, tariffs. For example, his deregulation efforts across the board and his efforts to promote fossil fuels should have enormous beneficial effects in bringing energy prices down. And of course, that's the basis for all cost structures for all industries nationwide. So I know this week gas is below $3 a gallon for the first time since May of 2021. So markets are already adjusting to the fact that energy prices are likely to come down quite a bit, and deregulation is likely to bring down costs quite a bit. And we're going to get rid of a lot of these sort of renewable energy type mandates that are clogging up different parts. So it's possible that we make progress on the deficit. But I think more than anything, gold will be responding to this very large number, 36 trillion, and the interest costs of supporting that, as well as the ongoing deficit in that $1.8 trillion range. So President Trump has his work cut out for him, and we wish him the best, but we're not that optimistic.
Trey, final question for you. How might the geopolitical uncertainty surrounding a second Trump administration impact both the US dollar and global demand for gold as a hedge?
There's no question the world, having had practice, is much better equipped to negotiate with President Trump when he has a position on tariffs, et cetera. For example, just this past week, Trump floated 25% across the board tariff on Mexico and Canada if they don't close the border and stop the influx of fentanyl. And within 48 hours, Scheinbaum in Mexico was talking about getting the army ginned up to stop migrant crowds, and Prime Minister Trudeau made it all the way down to Mar-a-Lago, which is pretty amazing. There's sort of an infamous handshake when Trump is grabbing his hand. And so in other words, the responsiveness to President Trump is obviously much better developed than it had been in 2016. So there are also other differences insofar as Trump's first cabinet was pretty establishment neocon with people like Mike Pompeo and Nikki Haley and John Bolton and Kelly. And the current administration that is taking shape appears to be much more of an anti-war bent with Marco Rubio and Tulsi Gabbard and Hegseth. So whatever form that finally takes, we expect this administration to be a little bit more pragmatic and less confrontational than the last. So hopefully that will help a little. But there are really two groups. Number one, the Russia, China, Iran type axis, and they're clearly going to be motivated to reduce the influence of the dollar standard system moving forward. And then we have this BRICS type group of countries, which is the next 40, who are also looking to increase use of their national currencies and are going to chafe, I think, a little bit at the Trump approach. So in our view, the dollar standard system will continue to face significant headwinds during the second Trump administration, and gold's allure as a investment grade monetary reserve is only set to increase.
Trey, thank you so much for sharing your insights and perspectives on the dynamics shaping the gold market, especially in today's complex geopolitical and economic landscape. As always, your analysis provides us with a deeper understanding of why gold continues to be such a critical asset in these uncertain times. Thanks again.